The $21 trillion warning, the market's signal that looks like 2008 yesterday morning, March 4, 2026. At exactly 11:23 Eastern Time, a message quietly appeared in the financial world. It wasn't a prediction, it wasn't a forecast, it was a warning. The message came from Peter Oppenheimer, Goldman Sachs chief global equity strategist, a man who has spent nearly 2 decades studying global markets and identifying patterns before they become obvious. This is the same strategist who warned investors about the Sell America trade in 2024 when almost nobody believed it. The same strategist who advised investors to diversify internationally when U.S. tech stocks seemed unstoppable. And the same strategist who predicted that the S&P 500 might only deliver about 6.5% annual returns over the next decade when many analysts were promising 15%. But yesterday he said something that should make every middle-class investor pay attention. For words, the same warning signs. The same warning signs that appeared before the 2008 financial crisis. The crisis that erased $16 trillion in household wealth. The crisis that destroyed retirement accounts. The crisis that wiped out nearly 40% of stock market value. And here is the number that most people are not talking about right now. If the stock market corrects just 12% from current levels, roughly $21 trillion of household wealth could disappear. Not slowly, not over years, but potentially in weeks, because when market corrections begin, they often move faster than people expect. The dot-com crash erased $3 trillion in about 3 months. The financial crisis destroyed $16 trillion over roughly 18 months. But today's markets move much faster than they did in 2008. Algorithmic trading, high-frequency trading, instant information. What once took months can now happen in days. And the group that gets hit first is almost always the same. The middle class, not hedge funds, not billionaires, not institutions, the middle class. Because of something very few people fully understand. The structure of 401k retirement accounts. To understand why that matters, we need to go back to 2007. In March 2007, 2 hedge funds run by Bear Stearns collapsed. Together they lost about $1.6 billion tied to subprime mortgage securities. At the time, Wall Street called it an isolated event. CNBC headlines said the worst was already over. Analysts insisted the problem was contained. Then in September 2007, something else happened. Northern Rock, a British bank, experienced the first bank run in the United Kingdom in over 140 years. Again, markets dismissed it. Different country, different system, nothing systemic. But by March 2008, Bear Stearns itself collapsed. The entire investment bank, founded 85 years earlier, disappeared in just 72 hours. And still, officials said the financial system was stable. Until September 15, 2008, Lehman Brothers filed for bankruptcy. In just 3 trading sessions, the S&P 500 lost 22%. $1.3 trillion vanished in 3 days. What most people forget is that the warning signs existed 18 months before the crash. Markets ignored them because every dip recovered. Now fast forward to March 2026. Peter Oppenheimer's warning highlighted several conditions that look disturbingly similar to the pre-crisis period. First, valuations across global markets are extremely high relative to historical averages. Second, cyclical stocks are trading at nearly the same valuation as defensive stocks. This rarely happens and usually signals excessive optimism among investors. Third, technology stocks, which led markets for years, have recently experienced their weakest relative performance in decades. And fourth, the equity risk premium is nearly zero. That means stocks currently offer almost no additional return compared to government bonds. Despite carrying significantly more risk, when investors accept equity risk without extra reward, it often indicates complacency. And complacency is frequently present before major corrections. Now consider the bigger picture. Total U.S. household wealth recently reached about $180 trillion. Of that amount, roughly $61 trillion is tied to stocks, either directly or through retirement accounts like 401ks and pension funds. If stock markets decline 12%, that alone would erase more than $7 trillion in equity value. But because stocks influence pension funds, insurance portfolios, and household balance sheets, the ripple effect could reduce household wealth by more than $20 trillion. And the middle class would feel that impact the most. Why? Because unlike wealthy investors who diversify into hedge funds, commodities, private equity, and global assets, middle-class families typically concentrate most of their wealth in 2 places: their home equity and their retirement accounts. For many households, 70 to 80% of their total net worth sits in those 2 assets. And retirement accounts themselves are heavily invested in stocks, which means a sudden correction can immediately affect the middle class more than almost any other group. Now add another factor: the political cycle. The United States is heading toward midterm elections in November 2026. Historically, midterm election years have been volatile for markets. The average drawdown during these years is around 19%. Combine that with elevated valuations, rising geopolitical tensions, and signs of credit stress in the economy, and you begin to see why analysts are paying attention. None of this guarantees a crash. Markets may continue rising, but the conditions that often precede large corrections are clearly present. And history shows that ignoring those signals has rarely ended well. The real question is not whether markets will experience volatility, because eventually they always do. The real question is whether investors understand their exposure before it happens, because when corrections arrive, they rarely give people much time to react.